I'm Mark Marley, and I help entrepreneurs scale their business to get maximum valuation at time of exit. When it's time to start thinking about mergers and acquisitions, it's important to know what your company is worth and what you can do ahead of time to maximize that valuation. It doesn't seem like it's an exciting thing to do. You start looking at P&Ls and balance sheets and trying to figure your EBITDA and your SDE. But I'm going to give you a couple pointers today that'll help you understand this better and hopefully make it to where you can use this to structure your business for that eventual sale. Eventually, everyone exits their business, whether it's by choice or whether it's by force, by sometimes a disagreement with a partner, a marital issue. It could be as simple as a health issue that just takes you or your family out of commission and you just can't run your company. It's good to have your company ready, structured, not when you're looking to sell it, but in advance, way in advance, and run your company every month as though you're looking to sell it. Because that's more likely when you're going to start getting offers is when things are going well and you're not looking to sell your company. When it gets to a position when you're trying to market your company because you need to sell it, chances are that you won't get the maximum valuation. You might be rushed through the whole process. People ask about, how do you value a company? I primarily work with service-based companies. And when we look at valuation, we really look at, EBITDA, and then, which is really earnings before interest, taxes, depreciation, and amortization. And what it does, it gives a way to normalize the earnings of the company across multiple companies so that it's a standard. Because some companies might have more leverage or more financial issues or more loans. And the buyer really doesn't care about those things because they're not going to have, they probably won't bring those loans into the purchase anyways. So they want to levelize it, normalize it, so you can truly see what the company's worth and how much cash it'll bring them after the acquisition. And the other term is SDE. And the thing about SDE, it's seller discretionary earnings. Because we know as a small business, typically SDE comes into play under about $2 million. Under $2 million, EBITDA sometimes doesn't work well. Because what happens with those smaller businesses is you've got a business owner who takes a lot of compensation out sometimes in a different structure. It could be disbursements, it could be a smaller salary, it could be they take it out in benefits by adding expenses to the company, which they write off, but then they use those expenses somewhere from their personal life. And that helps them lower their tax burden. One of the challenges when you start looking at selling your company is that all these years you wanted your company to make less money on the books so that you could maximize, or minimize how many taxes you pay. But then when you start selling your company and you look at your profit and loss statement, they go, man, you're not making any money. But you feel like you've been living well. It's a lifestyle business. You've done well. You made a couple $1 million in sales. But your P&L shows you're not making much money. Because if you did, then you'd be paying a lot more in taxes. So with SDE, what we typically do is some owners will not take any money out at all. They'll just continue to build value. And some take it all out every month. We have to normalize that so that when we're looking to acquire your company, we know truly how much money without any earnings for the owner or any of those miscellaneous discretionary expenses we can take out to show us how much we expect to earn the first month, the first quarter, and the first year after the acquisition of your company. So I'm going to show you something on a profit and loss statement. I won't get too detailed today, keep this short, but I want to show you the difference between the P&L that you show that you may turn into your tax returns to minimize your tax burden, your liabilities and taxes, but how you can then adjust that when you start looking at acquisitions to get a true value of your company. Okay, I'm looking here at a P&L. This is for an IT management company. And I put some sample accounts in to give you an idea. But this is a company here looking, they're doing about $105,000 a month in managed revenue. A total sales example, $110,000 a month. When you scroll down through the cost of goods sold, I'll cover that in a minute, and your expenses, and then you look at the bottom line. If you look at the bottom line, this company on the tax side, on the P&L, showed they made $12,000. Well, when you look at $12,000 a month profit on a company doing over $100,000 a month, the valuation may not be great. You've got a lot of loss in there, a lot of expenses that we can probably cut out. But then what I do is, if you look at the end result, after going through removing the discretionary spending of the owner, we're at $29,000 a year, which is a difference of $201,000 in EBITDA increase in that year. And I'm going to show you in a minute what that does at the very end. So I'm not asking you to take out a lot of expenses. You might want to start running more lean if you're thinking about selling your company to make it look good on paper. You want a good story at the end, a profit story. But the cost of goods sold, there's not a lot you can do there to lower that. Typically, the owners are not hiding expenses, personal expenses, in the cost of goods sold. Those are the expenses it takes to actually provide services to your company. All your if in the managed service business, those are your tools, your products like Microsoft 365, your cloud services, and I also include my technicians' salaries in there as well, because it's truly required to deliver services. But we really get creative is looking at the expenses. The expenses, like understanding like this company here, the owner had a bunch of expenses that he was running side businesses as well, in addition to his primary technology business. And a lot of the expenses like marketing were used for the other businesses, but he wrote them off this business because there was income there to offset it. Insurance carries over. I'll look at you don't take out much insurance. It's going to carry over to the new owner. One thing about too, we take out, like here, this particular company had a couple loans. So we look, there's credit card interest, there's loan interest. We take that out. And I get more detail at a different time about this. And then you look at, meals. I put in here meals, office snacks, the mileage of the owner. A lot of things in here, like we take out the, office expenses, coffee and cleaning supplies. A lot of times people take those supplies to their home and they write them off their corporate expenses. It just happens. If you look at the next, so I have my general ledger here that shows my P&L printed right out of QuickBooks. And then you've got the adjustment. Anything you want to take out, you put in this field here for adjustments. You always put a reason. You got to justify to the new owners why you're taking that out, because they're going to look at it and try to lower the cost of their investment into your company. But you've got to say, look, when I leave, these expenses leave. I'm using them as expenses right now, but they're discretionary. They're totally gone. You justify it here with the reason. And then also the adjusted P&L is truly what we're going to look at when we go to look at purchasing your company, the profit and loss. An example here, professional fees, postage delivery, part-time bookkeeper we no longer need. The phones, example, here's something on the phones. Their telephone bill is $593 a month. Well, some of those phones belong to the family. So I might take out $200 of that a month. And then, because the new company will not be paying my family's cell phone bills. Car rentals, travel. I made a note here that the main owner's travel was for other purposes. We took that all out, if you can see here. And then like TV providers and stuff. Honestly, there's a TV provider that's probably used at the home office. Tools. We do got to keep all the tools that it takes to operate as a company. You can't be taking things out that are required to provide services to your client, because it's going to hurt you in the long run anyways. So if they're legitimate expenses, you want to make sure that you leave them in. It's also good at this time, a lot of IT companies that I look at have a really simplified chart of accounts. They have their income, their expenses, and their cost of goods sold. I like to break things down, especially if you're going to start thinking about, adding value to your company, to sell your company. It's good if you have individual things broken out. so that you know what needs to come out for the discretionary spending or for the EBITDA to take the discretionary expenses out. The big thing was, if you notice, we went from $12,000 a month of standard P&L that I would turn in on taxes to almost $30,000 a month. Well, that $30,000 a month turns into an annual increase of income of $204,000. Well, in the IT space right now, we're seeing valuations of 4 to 4.5 times the earnings of the company, times the EBITDA. So what I want to do is I want to show you that what it means to a valuation. Those slight little changes by taking those discretionary expenses out, taking out the owner's salary and compensation, ends up increasing the value of the company by $816,000, almost $817,000. That's the difference. If you can justify the discretionary earnings and discretionary spending, take it out, adjust it out so that it's not listed on the profit and loss. And that will actually help you achieve the goals that you want to achieve in getting a true evaluation to know what your company is essentially worth. There's a lot more goes into valuation of your service-based company, your managed service company. But one thing you have to do up front is have your financials in order. And your financials that you show need to match the tax returns that you submit. That's the validation of your financials that you're submitting. And if you have a CPA that works with you and they can do an audit or some audited financial returns, then you're much better off, because your due diligence phase will take much less time if you have a CPA who's actually doing audited returns or financial statement.